All right. I'm Don Lucier. I'm a partner at Saul Ewing. And let me first say quickly, on behalf of all my colleagues at Saul Ewing, we're really thrilled to be part of this. It's been a great program so far, and it's no doubt going to continue here. So without further ado, the panel we have today is Rodrigo Niño, the CEO of Prodigy Network, who will be discussing how crowdfunding can be used in a large scale, both here and internationally. So
very good. So I guess that the best way to tell you a little bit of what we do is through our projects. I am originally from Colombia, but I've been here in the States for 18 years now. And I didn't do business in Colombia up until probably 2009. And this is Bogota, where I was born. And here are some of the projects, just to give you a few examples. The first one is BD Bogota. It is a skyscraper in downtown Bogota. In Bogota, you have 10 million people living everywhere. And you have 1.7 million of them working in downtown. And they commute everywhere else. If we go back here, this is probably downtown, and you see how far the city extends and how flat it really is. It's a huge pancake, or we should say probably an arepa instead. And you guys know better, you know, the urban problems that it entails. You have a pollution, traffic is truly a problem. The average commute is over 52 minutes on any direction. So the solution, and we may open a conversation about it, but we thought it was vertical densification. We had to go up and bring people to live downtown from everywhere else, so that the 1.7 would effectively live, work, and play over there. But the problem was that financing a skyscraper in Colombia with the traditional capital, with the traditional equity play is very difficult. Because let's say that a project is $300 million. Who's going to venture $60 million of equity and $240 million as a combination of junior and senior, going probably at 9% in pesos? We haven't seen a skyscraper in a generation. Over 82% of every skyscraper of this magnitude in emerging markets has failed in the past 50 years. So what we really see is that we have a huge urban problem because we had 12 cities with over 1 million people in the 19th century. Right now, we have over 500 cities with over 1 million people. We're just getting too many. We are right now 7.2 billion people in the world. By 2050, we're going to be over 11 billion. And the disconnect with the traditional equity and cities is there. So that's a problem. So we think that the disconnect, again, is the long-term component of the real estate with the short-term play of the traditional equity. In crowdfunding, we had 4,200 of those 1.7 affected individuals participate in a raise of $220 million. $220 million in an all-cash transaction with no senior and no junior financing. So if the project gets delayed by 6 months, nothing happens because these guys are investing in the solution of a problem or a need that they have. And in addition, they're doing it for a profit, which is in my mind the ultimate shared value paradigm because you're contributing to the solution of urban density problems and building cities, and you're redistributing income in a good way because we know that inequality is probably one of the conclusions of our model today. So another example is an office building that we have under development right now. On that one, we wanted to bring the crowd to the design of the building as well. So we created a bottom-up approach to the design, and we created a competition where the local population provided us with what they thought was the perfect building from an office standpoint. And then we opened it to a global competition for people from all over the world to provide solutions. And we got over 82 entries from over 22 countries participating in that conversation to create the design. By the time that it isn't designed by committee, because that's very challenging. It is a bottom-up approach, you know, where you have a conversation between curators and the crowd. By the time we had finished the competition, we had already funded the project as well. in less than 3 months. It's now under construction. We like art, which is the third project, from a contemporary standpoint. And the need there is that in the emerging markets, the young and upcoming artists, they have no means to pay for their work, and they also don't have a way to expose their work to art collectors and galleries. So we found a neighborhood in Bogota. We bought a bunch of houses with the crowd of collectors. You know, this is a very special crowd, we should say. And we renovate the houses. We found a group of curators that effectively picked the best artists, you know, from the countryside and from all over Latin America, and we bring them to live in these houses and work in these houses as well. And they pay us the rent in form of art that we take at 50% of the commercial value, which is the deal that they have normally with an art gallery. So when I went to the bank 5 years ago to get financing for this project, and I asked him if I could pay the loan interest, you know, in paintings, he looked at me and he said, listen, brother, I've known you for a long time. He was a high school friend of mine. Why don't you pay me in poems, you know, instead? Forget the paintings, you know, sing me a song. But with the crowd, you know, you have a bunch of people cooperating with artists, you know, and making something fun happening as well. So it becomes like a positive self-fulfilling prophecy, I should say, because the art appreciates, the property appreciates, and that's how you get things going in an urban environment as well. The last one is a hotel that is already underway. Anybody in the hospitality industry here? So you guys know better that it is all about loyalty. I was the other day, you know, I was talking to Alberto in the Mandarin in Barcelona, and I counted 11 towels from different sizes in the bathroom. These guys don't know what else to do to pamper guests. We think that you need to change the relationship, you know, between the guests and the owners and turn them into your partners in a building, in a business that is all about loyalty. It's all about loyalty. So we have in that building that is already operating, we stabilized the building in less than 4 months, when the ramp-up period for any hotel is normally between 12 to 24 months, because I have 1,100 local ambassadors of the brands. So everybody meets by celebrating in the property. You know, the food and beverage operation, which is normally a problem in an urban property in Bogota, it's filled up every weekend. They turn it into a club. So it brought it, and when they travel overseas, you know, they always do it, you know, with the hotel chain connected to the property as well. So those are the projects that we have done in Colombia, where effectively crowdfunding was born over 20 years ago as just another equity syndication, you know, model. Like we have seen many, many more. Because we as real estate people, we always look at this and we say, but what's the novelty? You know, we have seen equity syndication forever and in different venues. So the news is simple. It's just technology. It's the difference between Kodak and Instagram. That's really what it is. It's technology and regulation. Moving to the States. In 1933, how are we doing with the time? You're good. In 1933, Franklin Delano Roosevelt basically passed the Securities Act to prevent fraud from happening, you know, and to prevent the public, you know, from suffering from it. And they created the private offerings. And they said, okay, but we're going to create 2 restrictions for the private offerings. Number 1, it'll be only for accredited investors because they're wealthy and they know better. And number 2, you cannot do open solicitation. So essentially, if you analyze it carefully from the perspective of the crowd, that means that if you have a private offering, you can not only offer it to accredited investors, to a very small group here, but in addition to that, you have to offer it to people you know. That's it. So what is it that it translates into in commercial real estate? If I have a big building like the beautiful buildings that you see around you, that you can offer it only to people you know, that have the big, you know, checkbook to write you a $100 million check. And the huge paradox here, the elephant in the room, is that it was done to protect the American public from fraud. And I just leave it there. So what happened to the crowd that was so blatantly protected from fraud? What really happened to the crowd for 80 years, you know, it was secluded to a very low yield environment because it bought into the premise of low yield, low return. Okay? And I'm an expert, you will give me your money, and I will invest it in stocks, bonds, and commodities. But I'm going to sell you on the idea to buy a home first. And then you need to have a liquidity reserve. And then you need to have, your portfolio investment, and maybe, if you do a little better, some equity, and then your own business. After 80 years, we have seen that the traditional portfolio premise collapsed. That's the typical portfolio for the majority of the population, but whomever made it really inverted the portfolio. You first invest in equity in your business to get the returns, and then you start thinking about potentially buying a home. You don't want to burden the population with a home, but they don't get, the return they have. So for 80 years, these guys, we all ended up in a very low yield environment. And then we had 2007. And in 2007, there was proof that fraud wasn't really avoided, with the Securities Act, I should say. Number one, it wasn't. It wasn't really prevented. We have seen a ton of examples of it. Number two, there wasn't a low risk. And number three, there wasn't even a low return. So people got fed up. And they said, don't talk to me about experts anymore. Be a curator, but I'm going to be making the decisions now. And surprisingly so, right then, 3 asset classes popped up. 1, treasuries, 2, gold, and 3, specific commercial real estate assets in 10 major metropolitan areas. Hotels, rentals, retail, extended stays, and office buildings. But it wasn't REITs, with all the respect, because the correlation with the stock market was huge. It was specific discrete assets that dropped only 2.5% in price, while the median from a national perspective was 10. But if you have a cash flow, nothing really happens to you. So that's how big institutions and wealthy families protected the integrity of their capital in the worst crisis that we have seen since the Great Depression. And it was just sitting there as a clean conclusion. Anybody of you can go back and see what was the single most predictable asset class, and you will find that it was commercial real estate properties in 10 metropolitan areas, and out of which New York was number 1. So what happened to the crowd in connection to that? They just didn't have access to it because you couldn't openly solicit a single asset retail fund because you're protecting them from fraud. So the contradiction became too much. You are protecting them from fraud by precluding them from invest in the one asset that preserved capital over the worst crisis that we have seen recently. And then we had, after the flight to quality, the Jobs Act that just changed that. And it eliminated the open solicitation to accredited investors. Quite frankly, I don't know why is it that there is still a protection, quote unquote, to unaccredited investors. But so far so good, because at least for now, actually every accredited investor can participate in these assets. So let me give you a few examples of the deals that we have done here in New York. This is AK Wall Street, $120 million project. Senior financing from CIBC at LIBOR plus 2 fixed for 5 years. Junior financing from MS, a pension fund administrator, for probably 20% of the equity, and the rest is common equity from the crowd from 6 countries. For a total of $120 million. 3 blocks off the World Trade Center, we expect an IRR to the crowd of 23%. That has never seen anything above a 9% in their lives. Wait until they get a 23% return check on their $50,000 investment. The second project, 17 John, 1 block off the World Trade Center. We got investors there in the same fashion, financing from Deutsche Bank, another junior from MS and company, and we got investors, we got $32 million from investors from 17 countries now, 17 countries and 12 different states. AKA United Nations is a recap. On 46th and between 2nd and 3rd, $10 million from the crowd. We got financing from Bank of America, and MS again partnering up to provide us with the junior piece. In total, we have done projects worth over $1 billion, and we have raised over $300 million in common equity, no debt, in common equity. And we have participated with senior financiers, and we are participating with pension funds as well. Because surprisingly so, we thought that it was an antagonistic approach, and it isn't. It's really cooperative, which is great. And it provides, relative to the developers, an alternative source of equity. That is, number one, cheaper, that's the bottom line. And number two, more flexible because it is lined up with the long-term component of the real estate. So in the last project, we were chosen over 26 bids that were in a margin of 3% over BlackRock and a bunch of great reputable firms by the Corman family, which is a fourth-generation developer here in the United States. They have been doing business for over 100 years because to us, obviously, it's all about the execution of the underlying asset. And transparency as well is a must. For that matter, we think that we are really seeing and witnessing the creation of a fourth asset class. Now we have it for international investors, and we're moving to get it for domestic investors into Bloomberg. We have an IC number, we have an NAV, a net asset valuation, we had a bid and an offer, and people can trade it, from the portfolios already. It is there. Eventually, in a few years, you will see people handling their own portfolios. You will see people having ratings for the different assets, people investing here in New York in AAAs, people investing, in emerging markets in triple Bs, and you will see a mobility of capital that we have never seen before in our traditional, long, and boring commercial real estate industry. Thank you very much.
We ran over, but definitely want to give people a chance to ask questions if there's any questions. Yeah.
For Rodrigo, in your investments in crowdfunding in Colombia, is the legislation in place already, or are you basing your structure in U.S. law and investing?
That is actually a very good question, because what we have found when this whole crowdfunding, first of all, let me tell you that I called it crowdfunding long after I was already doing it, precisely because of what you're saying. They came up with this crowdfunding thing with Kickstarter and everything. That was great. But the legal structure there in Colombia was in place for already 20 years. Because when equity started to be syndicated in the last financial crisis, developers started, getting equity from friends and family. But obviously, there was a big fraud component. So the government intervened and created these third-party fiduciary companies to regulate the conversation between the developers and the crowd. There hasn't been a single case of fraud in over 20 years. And there isn't a restriction on unaccredited investors, because we understand down there that the protection to investors doesn't come from letting them invest in small projects. That just doesn't make any sense. So to answer your question specifically, there are legal structures around the world in different countries that people just haven't used for the purpose of crowdfunding.
Yes.
Yeah. So for development projects, how do you deal with capital calls with cost overruns?
Two ways. We are a JV. It really depends on the platform. We have a bunch of friends in the industry, like Realty Mogul and Fundrise, which are great people. We are JV equity. So in a way, strong ownership, is really the answer, number one. You need to have a real GP committed, to provide the equity if needed. But if worse comes to worse, you just do you just make a regular capital call and everybody will fund it.
You'll go back to.
Oh yeah,
Our plan was to not go back.
exactly.
Our plan was to leave the crowd money set aside, fixed amount, keep it simple, because it's too difficult. And then you deal with the capital call or cost overruns between you and your equity partner, how you would normally do it on a regular project. And it just means you're not going to get any more money. It's like if you got a fixed mezz, you're not going to go back to the mezz lender and get
Which is
more.
essentially having a very strong owner, That's the only way.
Right.
So you determine the promised returns to the crowd, without any form of consultation with intermediaries? You just decide what you need to offer to raise the money, and that's it?
No, not really. We are very thorough when it comes to that, and the good thing is that crowdfunding is it's just about the access. There's nothing new about it. The rest, is the underlying asset. So you essentially just check, and in the way you do any of your projections and your performance, with the assets there, particularly in the assets we focus on, it's somewhat predictable, to know what the return is going to be here in any of these New York projects. So we just do our projections and run our projections that are good for the banks, good for the institutional investors that participate with us, good for a developer like Corman, it will be good for the crowd as well.
Is there a minimum threshold that has to be achieved by the crowd in order for the entire deal to be effective?
Yes.
I don't mean a return, I mean the amount of money invested.
Yes. However, we work obviously based on the nature of our projects with large institutional equity partners that would provide us open blanket facilities if needed, because we don't want to put anybody at stake. However, the more simple answer is that you would define a threshold to meet, and then you go ahead and you raise your equity. We put it in escrow. And we are handled by a third-party professional fund administrator, FTI in this case, which is a public company. And if we don't raise the equity, in the absence of an open blanket commitment, we would have to get back the money to the investors and lose potentially our deposit, because obviously that one cannot be put at risk as well with money from the crowd.
Okay, one more question? Yeah. Way back.
For Rodrigo, are there any aspects of the condo hotels that were built in Miami and Miami that would help you with the tail end of making the properties more liquid to the investors?
The condo hotel model, actually, I don't know if that would be a product for me to put on a crowdfunding platform, just because I don't know if I am.
She was saying
The liquidity de los.
Oh, then go ahead.
No, what we're thinking is to make this product even more interesting, what we're trying to do, definitely if the person wants to move and stop renting, you actually have to buy them out of the fiduciary rights. And it's actually that I actually was discussing with Rodrigo is how do you create that liquidity for those investors? What we are thinking right now is actually even bringing new type of investors that would just provide that liquidity. But if not, you would have to find a new investor somewhere to actually take it. It's easier to transfer. The thing is that immediate liquidity, so far it's complicated to provide.